Okay, so we are going to pick up here, and this is a little different from how I've been recording the prior videos for this cost unit because I'm right on my computer now instead of writing on the slides from my iPad, because once we get through these slides, I'm going to sort of show you how to solve some problems. So, all of this talk about costs has really been oriented towards basically trying to figure out what your production or what your products that you're making cost, your cost of goods sold, really. And so when we think about the costs of a product, there are both direct and indirect costs, as we've been discussing. Okay, so the first thing we want to talk about is direct materials, and direct materials are part of the final product, and they are directly traceable to the goods being produced, as we discussed. Direct labor is the labor that can be directly traced to the goods being produced, so you can actually look and measure how much time people are spending on a product. You can also, this isn't only used in manufacturing, of course. We measure direct labor in things like, our favorite example in this class, landscaping company, or construction projects, things like that. So, there is labor can be broken out into both direct labor and indirect labor. So even if you have besides the labor involved in like full-blown supervision, upper level management, things like that, you can have indirect labor of the supervision on the job sites or the supervision in the factory, things like that, right? So there's direct labor, which is the people that are actually being charged with producing the goods that are being sold, and indirect labor, which would be part of manufacturing overhead. And then as we move a little bit more in detail on overhead, anything that's involved in your manufacturing that is not direct materials and direct labor is manufacturing overhead. It's also called burden, factory burden, or indirect manufacturing costs. And they're included, so we include costs into manufacturing overhead if they can't be traced directly to any particular cost object of interest, but they are part of the cost of doing business at your manufacturing plant. So the kinds of things that are included in manufacturing overhead would be things like depreciation on your plant buildings, or maintenance labor, supervision, materials handling, electricity and property taxes, things like that for the productive activities for the manufacturing plant. So here is where we've been aiming, right? We want to figure out how to calculate our total product cost, because our product costs is our cost of goods sold, which is one of the most important things. We saw that in financial accounting, and basically this is how you get to it. So your total product cost is all of your direct materials, all of your direct labor, and all of your manufacturing overhead. That's your total product cost. And then to get to your unit product cost, you divide up your total product cost by the number of units that you produced. And so it's incredibly important, absolutely essential to be able to keep track of unit costs. That's why we include that as the first managerial accounting topic here in this accounting class that you're taking. Now, we are going to use product costs when we develop budgets, which we will do later in the semester. And, that again, as I keep saying, all managers, not just financial managers, not just accountants, all managers are responsible for budgets. And, you can't do a budget without understanding what your product costs are, or what your unit costs, what your cost of goods sold, however you want to think of it. So that's why we're doing this. Okay, so I've gotten to the end of the PowerPoint, and now what I'm going to do is shut this down and open it back up with some problems that I'm going to solve out for you. to show you how. Okay, so here we go, folks. This is where we've been heading with all of this work with the costs. And what I've got over here, I've got a problem set, which I'm going to run through. There's 5 of them. And then over here, I've got my iPad mirroring. And I'm just going to work through them by hand the way that I would expect that you guys would. And yeah, so let's get going. So we have Walkman Company produces a product with the following per unit costs. And we have direct material of $25 per unit and direct labor of $16 per unit and manufacturing overhead of $19 per unit. Now, I should note that the way that you determine overhead per unit is you take your total number of overhead, your total number of units that you produce for a period of time, usually a month, and you divide your total overhead by the number of units that you produce for that month. And that gives you your overhead per unit. Okay? So last year, we made 4,000 units. At $75 price. And our total selling and administrative expenses were $30,000 for the year. And so our question is, what is our gross margin? Now, here's the thing, right? Remember that I said I wanted to teach you guys how to set up these problems, because that seems to be a challenge for you all. And so the first thing we need to do to set up a quantitative problem like this is to remember what gross margin actually is, right? So remember our gross margin, and if you don't remember, this is from our financial accounting unit. So our gross margin is total revenues minus, let's say minus, cost of goods sold. And as I said in the slides, the product cost is cost of goods sold. Okay? So what we have to do, let's figure out our total per unit product cost. It is 25 plus 16 plus 19, which is, pardon me while I go off camera and use Excel to figure this out for me, which is 60. Okay? So our total per unit product cost is 60, and our price is 75. And so, you know, the long way is the long way to calculate right, our total revenue. Here, you know what? I'll make this. There we go. Okay, our total revenue is $75, which is the price, times 4,000 units. And then our total cost of goods sold is $60, times 4,000 units. All right, so our total revenue is 300,000, and our total cost of goods sold is 240,000. So our total gross margin is $60,000. Now, I want to note here, right? We were given information in this problem. Here, I'll make that red. We were given information in this problem that we didn't actually need, right? And you're going to find that a lot in these accounting problems, right? The point of this is to help you learn how to set these up, right? And so you set them up by knowing what to use and what to ignore, and also by knowing vocabulary, right? So this is the application of the vocabulary that we've been using, okay? Next problem. Okay, let me get a fresh page. We've got hockey sticks in this example. There we go. Okay, we've got hockey sticks in this example. We've got Slapshot Company making ice hockey sticks. Last week, direct materials costing $32,000 were put into production. Direct labor of $28,000 was incurred, and our overhead equaled $60,000. And over the course of the week, we made 500 hockey sticks. So again, let's write that down. We want total product cost. So let's see, direct materials were total were 32,000, and direct labor was 28,000, and overhead was 60,000. Okay, and we made 500 sticks. Okay, so the total product cost for the week, that's easy. You just add these three up. 32 plus 28 plus 60 is 120,000. Right? Easy enough. And then our per unit cost was 120,000 divided by 500. Or, so that's $240 per unit. Which seems really high. But it is what it is. I don't know what hockey sticks cost. Okay, easy enough. Next problem. We have Barnard Company. Okay, and this one we're going to have the same questions for, or the same values for several questions. You're seeing a pattern here, I'm sure, right? Direct material, 50,000. Direct labor is 20,000. Manufacturing overhead was 130. And selling was 40. And administrative was $36,000. Okay, we produced 10,000 units. These are all dollars. We just keep our numbers and our signs straight. We produced 10,000 units, and the price was $31 per unit. Okay, so we're going to have a series of questions here. Right, so the first question is the cost of goods sold per unit. So again, we need to remember that we've got information that we don't actually need, right? We don't need selling and administrative expenses in order to calculate the cost of goods sold. Cost of goods sold is simply direct materials, direct labor, and manufacturing overhead. So that's 50 plus 20 plus 130, which is our total product cost, which is so our total product cost is 50 plus 20 plus 130, which is $200,000, right? So that means that our cost of goods sold per unit, if we divide that by 10,000 units, our cost of goods sold per unit is $20. Okay, that's easy, right? Okay, let's move on to the next one. I'm going to erase the lower half of this. Here's our next question, same setup. So let me get my eraser out. Okay. So, the gross margin per unit. So remember, we got the cost of goods sold per unit. That was $20. So what's our gross margin per unit? Well, again, we need to remember that gross margin is gross margin total is your total revenue minus your total cost of goods sold. So gross margin per unit is going to be equal to the price minus the cost of goods sold, or the product cost per unit. Okay, so our gross margin per unit, very simply, is going to be $31 price minus $20, which was our cost of goods sold per unit, so our gross margin is $11. Easy peasy. Last one. Okay, now we need to figure out operating income. Okay, so let's erase this stuff down here. Now, first of all, in order to calculate operating income, we need to remember what operating income is. So let's set up, I'm going to make a different color pen. Let's set up an income statement to remember what operating income is. So our revenues minus our cost of goods sold gives us our gross margin, right? And then if we subtract out operating expenses, that gives us our operating income, or operating profit, however you want to call it. So now, we know that our revenues were $310,000, right? Because it's $31 per unit times 10,000 units, and our cost of goods sold was 240. No. And our cost of goods sold was $200,000 because it was $20 per unit times 10,000 units. So that gives us a gross margin of $110,000. $34,000. And then from that, we subtract our operating expenses, right? So we're going to subtract 76,000 operating expenses, which is 40 plus 36, right? So that gives us an operating income of $34,000. So they had $310,000 in sales, operating income of $34,000. That's about a 10% operating income, which isn't bad. It's not great, but it's not bad. So that's how you do these problems. I'm going to put up a whole bunch of practice problems that are similar to this that have the answers on them. And then once you've practiced and gotten really comfortable with them, go ahead and take an online quiz to make sure that you're able to do this work, okay? So that's where we're heading with this.